Hey everyone, today we're going to be talking about a very special topic that relates to businesses that have a lot of expensive stuff in them. And not understanding this is one of the ways that business buyers grossly overpay for businesses, or business sellers completely get inflated ideas about what their business might be worth. So if you are owning a business that has a lot of expensive stuff, equipment, etc., or if you're going to be buying a business in one of these domains where there's a lot of machinery and equipment, then you're definitely going to want to pay attention to this week's video. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right. So this video is coming out in the summer of 2025. And every summer, what I do is I release the holiday chat calls, which are a special promotional offer that I make every fall to people on my email list, where they can book hour-long calls with me at a substantial savings. They're basically 75 or 80% off the regular price. But the caveat is that we record them and we make them public. And so just recently, we had a public release of this one here, Holiday Chat 2024 Holiday Chat number 4. Ryan buys the site prep company, in which we talk about a major a business with a lot of major earth moving pieces of equipment. So this is a company that goes out and does all of the streets and curbs and gutters and sewer pipes, etc., for a subdivision. And so there's a lot of expensive gear in this business. And so we had this conversation, and we talked all about this business and about its earnings and how he might buy it, etc. And we forgot, the conversation just didn't follow into the area of depreciation and capital expenditures, which is a critical component of understanding these kinds of businesses. And I just, in re-listening to it, I thought, hey, I could make a special video in which I talk about this stuff, because it is such an important thing, and it catches most people off guard. And so, what I'm going to do to kick things off is I'm going to talk about depreciation, and I'm going to talk about how it works in the world of small business. And then we're going to talk about CapEx, and I'm going to show you how people, in not understanding these concepts, make terrible mistakes when they do business transactions. So, what is depreciation? Well, I have got a definition here that I'm going to share with you on my screen. I'm going to back myself out of here. So, this is from accountingtools.com. So, it says depreciation definition. This is from February 10th of this year. It says depreciation is a planned gradual reduction in the recorded value of an asset over its useful life by charging it to an expense. Depreciation is applied to fixed assets, which generally experience a loss in their utility over multiple years. The use of depreciation is intended to spread expense recognition over the period of time when a business expects to earn revenue from the use of an asset. Okay, so let me back out and talk about this in the real world. So if you've ever heard the expression, an automobile loses a good chunk of its value the minute you drive it off the lot, that's what depreciation is, right? So the whole idea is that when you buy a piece of equipment and then you own it for a period of time, its value declines as it becomes more and more worn out. Now, accountants, over the course of developing that industry, they've come up with different rules about how you depreciate certain assets, and they put them into classes or groupings which have different rules that might apply to them. So, for example, the leasehold improvements in a leased location, if you spend a bunch of money to fix up, so let's say a restaurant in a leased location, and you sign a 10-year lease, then an accountant might depreciate those fit ups over a 10-year period equally every year. So if you spent $500,000 on doing those renovations and you have a 10-year lease, then every year you might claim a depreciation expense of $50,000 as you wear out those improvements that you made to the location. Another common way to do it is what's called declining balance. So, declining balance basically recognizes the fact that pieces of machinery, in particular, or vehicles, for example, have greater depreciation earlier in their life than towards the end of their life. So, for example, you could have a vehicle, and let's use round numbers just to make it easy, a delivery truck of some kind that costs $100,000. And there could be a rule of a 30% declining balance depreciation. And these declining balance rules usually have a half depreciation in the first year kind of rule. So 30% of 100 grand is 30 grand, half of that is 15. So in the first year you own that truck, you only get to have an expense of $15,000. And so then the truck on your balance sheet goes from being 100,000 that you bought it at down to 85. In year 2, you get the full 30%. So 30% of 85 grand is what? It's about 24-ish grand or so. So then in the second year, you depreciate at $24,000. That depreciation is an expense on your income statement for tax purposes. The value on your balance sheet of the fixed asset goes down by that amount as well. And so this is what we call the book value. At that very moment, we would have depreciated over a third of the original purchase price of the truck. So that truck would have a book value of basically of 100 grand minus the 2 years of depreciation that we put on there. Now, here's where things depart from the world of mathematics versus reality. What could have happened in those 2 years? Well, in those 2 years, there could have been some kind of supply shock that happened to the truck manufacturing industry. There could have been the implementation of something like tariffs. Costs could have gone up like crazy. And now, if you wanted to buy a truck just like that one, it might cost 150 grand. So, in the real world, is that truck worth 70-ish thousand dollars? That might be the book value. It could actually be worth more because of what's happened comparatively in the marketplace for those kinds of pieces of equipment, right? Um, Conversely, if you're in the United States, for example, there was recently, the big beautiful bill which cemented bonus depreciation for small businesses. So an accountant could give you tax advice and say, "Hey, instead of doing this 30% declining balance, what we can do is we can actually depreciate the whole thing in 1 year, and you can get this huge tax savings," right? So now the book value is 0, but we do know that the thing is worth a lot of money, right? So depreciation is very much something that is a theoretical kind of concept in how it's applied in actual financial accounting in the world of business. Now, if you had a big business, like a business, big trucking company with hundreds and hundreds of trucks, and every year you had to buy 100 of them, right? Because of the turnover in the fleet, every year you'd be buying them at the higher and higher price. You would be depreciating them. You would have different groups of trucks at different ages throughout this depreciation schedule. What would end up happening is the depreciation that you would see on that company's income statement every year would likely have some sort of semblance to the real investment required to replace that fleet of trucks, right? But in the world of small business, if you might have, one truck, for example, then this completely can get off track from the world of reality. So why is this important? Well, in the example of the conversation that Ryan and I had about him buying this company that had a lot of earth moving equipment, trucks, backhoes, bulldozers, excavators, things like that, we didn't get into a conversation. He said that he had done some research about businesses that are selling, and he believed that the business that he was looking at was worth about 3 times sellers' discretionary earnings. Here's the problem: is that sellers' discretionary earnings and EBITDA, which are two common notional levels of cash flow that we use for business valuation, they do not include depreciation at all. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So when you look at a business and you calculate EBITDA, you add back any depreciation that you see there. And SDE is EBITDA with also the fair market value of the owner manager's wage added back as well. So that also doesn't include depreciation. And one of the things that I should have said during that call is I should have said, "Hey, Ryan, first of all, businesses like this, like trucking companies or, companies with a lot of big expensive gear, they actually never sell for multiples of EBITDA or SDE. The rules of thumb that exist out there that I've always seen for companies like this is that they sell for multiples of EBIT, which is earnings before interest and taxes. They leave the depreciation component in because there is such a huge requirement for reinvestment in big pieces of machinery and equipment, right? But here's the problem is if you are looking at a small business, that depreciation number you see on their income statement may be meaningless because of the situation I've just explained to you, right? We could have a situation where the value of equipment is increasing, and so the depreciation is too little. We could have an example where someone has taken some kind of bonus depreciation allowance that the tax code is letting them do, in which case the following year the depreciation would be nothing, even though in reality there's a valuable piece of equipment losing value potentially, right? So the number that appears on the tax return or the income statement of the business actually doesn't relate in any way to the true costs of investment that is required to keep this business going. And that investment is important because if you buy a business and you base your decision on how you're going to value it, or if you're selling a business and you get an idea of what your business might be worth, and you're basing it on this notional cash flow of EBITDA or SDE, you're not taking into account the money required to actually keep the business going because of the reinvestment that's going to be required, right? Because those two notional levels of cash flow don't include the equipment wearing out. And to quote Warren Buffett, unless magical fairies are going to come and buy you trucks and excavators and backhoes, you need to account for this in valuing the business. And so this brings us then to another important term, which I'm going to share with you here. I've got another definition, and this is here, let me make myself small on the screen here to improve our production values. Right. So this is CapEx or capital expenditure. So this is from corporatefinanceinstitute.com. It says a capital expenditure or CapEx for short is the payment with either cash or credit to purchase long-term physical or fixed assets used in a business's operations. The expenditures are capitalized. For example, they're not expensed directly on the company's income statement. They're capitalized on the balance sheet and are considered an investment by the company in expanding its business. CapEx is important for companies to grow and maintain their business by investing in new property, plant, and equipment, PP&E, often also called FF&E, furniture, fixtures, and equipment, products and technology. Financial analysts and investors pay close attention to a company's capital expenditures as they do not initially appear on the income statement but can have significant impact on cash flow. Right. And then it gives an example here of the Amazon.com cash flow statement. So this is not an income statement. This is a cash flow statement. But you can see here purchases of property and equipment, and it's got here 40 million, 61 million, 63 million, etc. So that's from Amazon.com, publicly traded company. So why is this idea of CapEx important? Well, this is actually what is being spent to acquire this stuff. Now, in the world of big business, every year they've got people making a budget of some kind. Here's the things we need to buy. So they buy those pieces of equipment. Those pieces of equipment then go on the balance sheet, and then the accountants will depreciate them, right? You see how all of this relates together. But the reason why CapEx is a much more important concept, I believe, in the world of small business is because these large capital expenditures are often not made on a regular basis in the world of small business. So let's get back to our delivery truck. You might buy that delivery truck in 1 year, and if you're not putting a lot of miles on it, that truck could serve the business for 10 years, right? And so it's long since been depreciated. The value of it could be going up or down. You may not get it appraised. You have really no idea what it's worth. It certainly becomes worth nothing on the balance sheet. And then all of a sudden, 1 year you want to go and replace it, and you find out that a new similar truck costs 180,000 now, right? And so this is important because if you buy this business and that truck is 8 years old, then and you're buying it based on EBITDA or SDE, then you're not taking into account the fact that you have this huge reinvestment expenditure coming up in 2 years that you're going to have to make. And guess where that money is going to come from? It's going to come out of the SDE or EBITDA. Now, you could, for example, lease the truck But again, that still means the payments are going to come out of your SDE or EBITDA. You could borrow money at the bank and you could buy the truck, which means that now, yes, you do get to have the value of the truck on your balance sheet. You're going to get to depreciate it to get some tax benefit. But guess what? You still have the cash flow burden of the money going to that bank loan. While I might remind you, you probably also are only 2 years into your business acquisition loan, right? And because of the business acquisition leverage, you may or may not qualify for a bank loan when you need to buy a new truck in 2 years' time. So, this is why, especially when we've got a business with a lot of heavy equipment, it's really important to have a consideration for what kind of money needs to be reinvested. Now, this is a topic that comes up a lot when we do our buyer insight analyses with people. And so those are consulting projects that we do, my team and I, when we're talking with somebody about buying a business who wants our help to make an offer. If you go to businessbuyeradvantage.com, at the very bottom of the page, there's a section for buyer insight analyses with a video that walks you through the process. But one of the things that we do in a buyer insight analysis is we create a CapEx budget. So we look at the value of the equipment, the fair market value that's estimated in the business, and then we have an estimate of what replacement equipment will cost versus the equipment that's already there and what the estimated lifespan of that equipment would be. And this creates then a CapEx budget. And so why do we need to do that? Well, we need to have some kind of allowance built into our offer because if there's $250,000 of SDE, you've got to number one, pay yourself out of that money if you're going to work full time because SDE includes an owner manager's salary. Then you have to take into account your debt service. So if you're going to borrow money to buy that business, you've got to have that money coming out of SDE as well. And then you have to estimate your taxes. In order to estimate taxes, you have to have some kind of idea or estimation of what depreciation might be, right? So this is where the capex budget comes in as well as estimating depreciation. Um, and then you actually have to do the capex allowance, right? You get to spend money replacing equipment. Now, here's the thing: is we might calculate, for example, that a business might have a capex need of 35,000 a year, but in the example I gave earlier of buying the business with the truck that's 8 years old, you might not use the capex allowance in every year, but you've got to build it into your long-term cash flow forecast, into your valuation, because eventually you will need to have that money available to go and make the payments either on the loan or the lease of that new truck. And where people really get themselves into a bind is when they completely ignore this stuff. Because what they'll do is they'll look at that SDE cash flow. They'll buy the business based on the idea that that cash flow is continuous and enduring and will always come to them, and then they end up having to start buying equipment. And this is the equivalent, literally, of people who get a car loan and they end up underwater on the car loan. And they go back to the car dealership, and the car dealership says, "Hey, don't worry. We'll give you an artificially high trade-in value for your car as long as you pay an artificially high price for the new car. And we'll roll your, sort of capital loss of your trade-in into the new loan." Right? And then there's people who do it again. And what ends up happening is you end up with a $50,000 loan on a $33,000 car or whatever it is, right? And you're just rolling these negative consequences down the road. And that's exactly what people do when they do a business acquisition for a business that has a large amount of capital equipment and they don't take into account a capex budget, is they end up paying for equipment over like a 10-year period, for example, in their acquisition loan, yet they have to start replacing that equipment long before the 10-year loan is up. And this is where people get into trouble. And thankfully, we have situations arise all the time where we'll show people these needs, these capex needs in the business that they're looking at buying, and then they'll make an offer taking all that into account, and then they'll get outbid by someone who doesn't think about any of this stuff. And, does that work for the seller? Sure. They get a higher price for their business. Does that work for our buyer? Well, they're often disappointed, but it's better to lose out on a deal like that than to end up overpaying and put yourself in such a treacherous situation just a couple years down the road. And so this whole capex depreciation thing requires a lot of consideration. And here's the other thing that's happening that is strange to most people in North America anyway. I'm also certified as a machinery and equipment appraiser. So what we're starting to see is we're starting to see something happen with equipment that usually has only been happening with real estate. So with real estate, a company buys a building, for example, and then on their books, they're depreciating the building potentially, and the book value goes down. But as we all know, real estate prices tend to move up, right? So companies will have this declining value of real estate on their balance sheet, but when they go to get financing at a bank, for example, the bank and everyone recognizes that, hey, the property is probably worth more than what's on the balance sheet. And so they end up with this off balance sheet equity that could potentially support a larger loan, for example, if they want to refinance the business. We're starting to see the same thing happening with equipment. Why? Because the cost of new equipment is jumping so quickly. And it has to do with, again, supply shocks from the COVID period and with the application of these tariffs. So, if any part of the supply chain goes in and out of the United States, then these added costs get tacked on and then they reverberate through the supply chain, where every person now further down the supply chain has this higher cost basis and everyone's trying to protect the same percentage margin or markup. And so the costs are amplifying through the supply chain. And what we're starting to see is that equipment that as little as a few years ago, a thing that could have been bought for 450,000 is now going for 700,000. And what it's doing is it's causing the value of the used equipment to go up, right? Because when accountants depreciate equipment, it's always pegged against the cost of the thing when it was purchased. It's entirely mathematical, right? But when I and my team come in and do an evaluation on equipment and we do an appraisal, what we're doing is we're using depreciation tables that depreciate versus new. And so what happens is the higher new prices go up for anything, you've actually got inflation outpacing the depreciation table. So we've got equipment that is 3, 4, 5, 6 years old that is still working out to a higher value than what was paid originally. So it's a really interesting time for this kind of stuff. But what it means is that if you are buying a business and you are looking at the depreciation number on the financial statements, you can be really misled as to what kind of money is required to renew or rejuvenate the capital base of that company. Anyway, thank you very much. If you haven't listened to the call with Ryan, I would urge you to do that. Those holiday chat calls are long, but they are in depth. I mean, it's a real one-on-one call that someone would get if they booked a call with me and wanted to chat about a deal that they were working on. And if you want help with your deal, again, go over to businessbuyeradvantage.com. There's all the different ways that we help people buy a business there. There's the online training program, which has just been completely renewed for 2025. Uh, More hours of content added on there, a bunch of new AI tools that are in there as well that help you on your buyer journey. There's the group coaching program, and finally the buyer insight analyses, where we work with people and help them put together a offer that makes sense on a business that will ultimately do what buying a business is supposed to do, which is to put you in a position of profitability and positive cash flow from the beginning. I mean, the only reason you would buy a business is to avoid the risk of doing a startup. You definitely don't want to buy a business and max yourself out and put your back against the wall from day one and then potentially not make any money. I mean, that just wouldn't make any sense. So the biggest risk in buying a business, obviously, is overpaying, and the second one was over leveraging. Anyway, with that, I'll say thank you very much for tuning in regularly to the show. If you want to support us in any way, put a comment down below. Comments show the algorithm that it's really great content. And if you know anyone who's might enjoy this video or it could help them out, please share it with them. It's the friendly and loving thing to do. And with that, I'll say thank you very much, and we'll see you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.